Can you beat the stock market? Maybe, maybe not. But today, we look at the most impactful research study the investing world has ever seen. Good morning, afternoon, or evening, and welcome to another episode of A Worthwhile Retirement. I am Jacob George. Today we discuss one of the most profound works of financial literature in history. I hope you are as excited as I am. But before we can get into that, please remember that the information in this podcast is general in nature and should not be taken as specific investment, legal, or tax advice for your particular situation. In 2002, a team of researchers over at S&P Dow Jones Indices started to measure whether or not it was better to just buy and hold a particular market index, or if you were better off attempting some method of buy-sell tactics with the intention of beating that market. And we know of this study as SPIVA, which stands for S&P Indices versus Active. If you've heard of SPIVA before, it would probably be in the context of passive versus active investing, because SPIVA is the ongoing comparison of the performance of thousands of mutual funds whose objective is to attempt to beat the market or some comparable index. And they've been capturing this data for over 20 years now and are continually publishing new scorecards every year. And to my knowledge, this is the first time that a study like this was ever conducted. It is the first objective data gathering process to compare mutual fund performance against market performance. And what would you imagine that they discovered? After just 5 years, 79% of large cap mutual funds underperformed the S&P 500. 79% of mutual funds failed to beat the S&P 500 after 5 years. After 10 years, what do you expect happened? Well, this number grew to 87% of professionally managed mutual funds failing to beat the S&P 500. And what about today, over 20 years later? How many mutual funds have failed to outperform the S&P 500 index? Over 95%. Let me say that again. Just since we have been measuring, since 2002, when it comes to large cap mutual funds trying to outperform the stock market, over 95% were unsuccessful. And the longer the time frame, that is, the longer the fund was trying this active management strategy, the greater the degree of the underperformance. The longer they tried, the worse it got. And that is basically SPIVA. And I encourage you not to just take my word for it, but go and view the data yourself. I've gone ahead and put a link to it in the episode description. But what do we do with this data? What do we make of this? Well, I consider this to be very, very good news for us. Because what we've learned is that you and I don't have to be a Wall Street investor to do well in the stock market. And that is even an understatement, because chances are, if you were to submit to the idea that you cannot beat the stock market, or that the odds of doing so successfully are very, very slim, and so rather you decide to buy and hold basic market indices, not only will you perform well, but odds are you will do better than these fund managers who do this professionally. Over time, you would almost certainly win. And this is huge. Do you understand what this means? Do you see the implications that it has on your ability to invest and on your portfolio? Well, let me share with you my 2 favorite takeaways from this discovery. Number 1, investing is easy. Creating an investment portfolio that will perform well and be appropriately diversified is a simple process. We might be able to make tweaks to it, but for the most part, portfolio creation should not be complicated. And not only the creation of the portfolio, but if it's true that a buy and hold strategy is more reliable and more lucrative than actively trying to beat the market, then portfolio management should be simple as well. There shouldn't be a lot of work going on within your portfolio. We don't need to be messing around with it, and we don't need to hire anybody else to mess around with it either, because investment implementation is easy. Now, what is hard is keeping this at the front of your mind when things get tough. The difficult part of investing is not pulling your money out of the market when the market inevitably crashes, because the market will crash. The challenge is sticking to the plan when, not if, but when that does happen. But concerning investment implementation, SPIVA has proved to us what many people were already suspecting, that investing is easy. And how encouraging is that? How great is it to never have to wonder if I should buy this stock or that stock? To never have to wonder if now is a good time to be in or out of the market. And SPIVA essentially frees us from even having to think about questions like these at all, because it doesn't matter anymore. Not only does investing not need to be complicated, but it doesn't need to be stressful. And that's worth saying again. Your investment portfolio should not be a source of stress in your life. You don't need to keep up with financial news to tell you whether or not a recession is incoming. Because by the way, I'll just save you some time and let you know that a recession is always incoming. But nobody knows when, and nobody knows how long it will be. So just have a plan in place for it and stop worrying about it. You and I have hard data available to us to remind us that investing is easy. And that's number 1. Number 2, if it is true that the market cannot be reliably beaten, and if it is true that investing is easy, then fees are everything. If it is the case that you can't outperform the market on a consistent basis, or at least that the attempt to do so is unfounded, then the mission of investing is to fully capture market returns while sharing them as little as possible. The goal of investing is to reliably reap all the returns made available to you by the capital markets without sharing them any more than is absolutely necessary. We live in a world where it is normal to share a significant portion of your returns with the investment management firm. When you add up all the management fees, 12b1 fees of affiliate mutual funds, front load fees, commissions, it's become common practice to share 2% or more of your returns, of your portfolio, with the financial services industry. And the effects of this are devastating. I made a short video to illustrate just how devastating in the episode description, but just know that this translates to working longer than you need to be, and more importantly, running out of retirement funds much more quickly than you should have. Now, I am not saying that there isn't a place to pay a financial professional for their services. If that were the case, I would be out of a job. But I would just strongly consider, if you work with a financial professional, you need to clearly understand how much you are paying and exactly what you are paying for. Because again, we live in a world where the default is to pay 2% for someone to manage an investment portfolio for you, which, by the way, is easy. So instead, our investing objective becomes fully capture market returns without sharing those returns any more than you need to be. This SPIVA research study empowers us to be smart investors, and it frees us from market worry. I hope you have found the data to be as encouraging to you as it was to me the first time I came across it. Thank you for listening, and I will see you next time.